Hey guys, welcome back to my channel again. So today I'm going to explain a framework that in my opinion is probably the most important framework to understand when it comes to trading. You can apply any strategy within this framework and I believe that without understanding this framework, it's really difficult and it's almost impossible to apply any strategy to make it consistent, okay? So let me quickly go into the chart to explain the framework to you guys. So doesn't matter what market you're trading. You could be trading NQ currencies, cryptocurrencies. You could be swing trading, day trading. This apply to anything. Okay. So the way the market move is, it's going to, generally speaking, market will be moving toward into one direction with momentum. Okay. And then once the momentum has run out, market is going to consolidate. Oops, sorry. I'm going to do this again. And it's going to consolidate. Okay. So after the consolidation, throughout this consolidation phase, market is just going to gather liquidity because the momentum has run out. And after it has gathered enough liquidity, and the market is going to choose to go another direction. This could be just reversal going up, or this could be continuing with the current direction that's already trending. Okay, and which is that is something that we will talk about in another video. But today, what we need to understand is the framework of any market is momentum, liquidity, consolidation, or you can say gathering liquidity and then momentum again. Okay, so when you come to the market, no matter what strategy do you trade, right? You could be ICT trader, supply demand trader, reversal trader, trend trader. You have to understand when you come to the market. First analysis that you have to do is to understand whether the market is currently in a momentum phase or the market is in a consolidation phase. Without having this understanding, just blindly implement your strategy, you're going to lose a lot of money. Okay, so for example, in ICT SMC space, there is a lot of trader who is inherently just a reversal trader. So what they do is they will come into the market, they will look at a Asia low or previous day low, right? For example, if the low was here from the previous day, the market open in, let's just hypothetically assume this is a London session, open up, came to this liquidity area. Let's say this is a previous day low. Okay, it took out this previous day low with momentum. Okay. And a lot of reversal trader they would just, as soon as they see this liquidity has been taken, they would be like, all right, the market is going to reverse. Okay, then they would take a long setup in here, which is, it's not incorrect in terms of framework, but what they do not understand is once the market has completed its momentum move, it's quite rare market is just going to do a V shape. Okay, market doesn't do V shape reversal quite often. What market always do is it gather liquidity into that area, and then what will happen in real market is market will come to this area, and after it take out the liquidity, the market is going to gather liquidity like this, right? And it's just going to create consolidation, but it's going to consolidate like this. Okay, this is not trending down with the liquidity. This is just slowly grinding down because momentum has run out, and the market does not have enough momentum generally in the same session to just completely go the other direction. Then what the market is going to do is it's going to consolidate liquidity into this area, but the way that it's going to consolidate it is probably just keep slowly grinding down. So all of these reversal traders do not understand this. They would just blindly enter the long position here, okay? Get stopped out, get stopped up, get stopped out, get stopped out, get stopped out, get stopped out, get stopped out. And then when it comes to a different session, the liquidity come back and reverse, and by then they already run out of their their profit. So that is something that every trader needs to understand. Okay, so when you come into the market, if you're a reversal trader, try to understand if the market is already in consolidation phase. Have a look at it. How long has it been consolidating for? Okay, if it just came to the consolidation phase after taking out the liquidity, you may want to wait for a little bit for the market to consolidate a little bit before you enter a position to the opposite side. Because if you watch the market long enough, you'll understand, especially when you trade in Q throughout the London session, if there was a momentum towards one direction, it is extremely rare within the same session market is just going to reverse into the other direction right away. Okay, it does happen sometimes. The V-shaped trades does happen, but you don't want to be associated to this type of a setup. You want to be learning and trade momentum, phase, and into that phase, just be patient. You know that throughout this time, at least for the next couple of hours, the market is just going to hang around in this area, which is equal slowly going up, going down. Sometimes it just goes up. One candle creates a fake out, and then a lot of traders just get excited. Oh my God, reversing! And then what it does, then another candle just come down, okay? And another spike candle just come down and take up both sides. The market is going to constantly doing this for a while, at least a couple of hours after a momentum move, okay? And then without understanding this, if you're just blindly reversing the market, you're going to constantly getting stop out before the actual move is going to happen, okay? So this is a very important framework to understand. This is exactly how I traded when I was trading at my FTMO account as well, because when I was an FTMO trader, I was essentially a swing trader, and most of my setup that I took was a reversal setup. And the way that I trade a reversal, this is probably the most important thing. I'll look at the hourly time frame and I'll see the market moving towards one direction impulsively, and then I would just wait. It's all about patience for the market to create liquidity in that area. And then once it has created enough liquidity, once you give it enough time, then you will enter a reversal position. Then you will know that the market is ready to choose direction. Again, it could be choose to keep going up or going down, but doesn't matter. But one thing that I made sure to do is I was not entering too early, so I kept constantly stopped out before the market to make that decision, okay? The mistake that I used to make when I was a new trader is, as soon as I see this point of interest area and I believe the market is going to reverse, then I just enter way too early, and then I got stuck into this phase of market trying to get the liquidity both sides, and I was exhausted mentally. You know, I was exhausting my financials, and eventually when the market decided to make the move, I ran out of all my energy, all my money, all my mental energy. Then when the actual moves happen, I'm just not in the right mindset to actually take that trade, okay? So essentially, this is something very important to understand for all traders, in my opinion, especially the SMC traders, because this is how the market works, okay? For every single market. And without understanding this concept, it is going to be extremely, extremely difficult to be a consistently profitable trader.